Hello and welcome back for another edition of London Direct. With the oil market sell-off and also woes in the Eurozone, it's easy to forget that Friday is non-farm payrolls day. Well, I've been getting analysis from Alistair Cotton from Currencies Direct. Okay, Alistair, we had a bumper NFP number last time. What are you expecting for this NFP Friday?
So not as good, unfortunately. Mid 200,000s, one would think. It might be slightly lower because of the previous month was sort of brought forward any extra job gains. So often in January, the number actually falls slightly from forecast. So it could even be sort of low 200,000s or something like that. So the trend is still intact. We're still looking at, plus 200,000 jobs created, but it might be slightly lower than expectations.
We know that job creation is so key for the Fed. Do you think there's a magic number they want in terms of the unemployment rate?
That's a really good question, because I think that's what the market's looking for in the Fed minutes coming out this evening. Any sort of mention about thresholds or anything like that, I don't think they're going to get it, but that's what they want. The Fed is going to continue to be deliberately vague about when they might begin to raise rates, and what they've been doing so far is promising to do it, or indicating that they might do it, then stepping back away from that. It's going to continue doing that until we really are in a position for raising rates. I don't think we're quite there yet, though.
This is obviously all a game of opinions. I spoke to someone yesterday who was actually predicting a rate rise by the Fed in this quarter.
Wow.
I know last time we spoke, you were thinking of 2016, maybe the end of this year.
Yeah.
If we do get a series of good NFP numbers coupled with good GDP, surely that's the environment for a rate hike?
Possibly, but the central banks, the Fed in particular, like to almost walk the market up towards a rate hike by dropping hints in their speeches from the Fed governors. We've had none of that yet. I think it will take at least 3 or 4 months for them to prep the markets and for the markets to get ready for that rate hike. I don't think we're there. I don't think we're going to get it in Q1, Q2 or Q3, Q4 at earliest.
Sure. Well, everyone's entitled to their opinion.
Yeah.
And of course, the other big story is the dollar in terms of the US economy. It keeps marching on higher. Yeah. Is that a theme? Do you think it's going to continue? Definitely, yeah. So in terms of, it's all going to be euro-based and dollar-based here. So we've got the dollar and the US economy outperforming, and then it's only going to accelerate once we get full-blown sovereign QE in the Eurozone. It's just going to push the euro-dollar exchange rate much lower towards that parity level, I would think, as soon as Mario Draghi officially announces it, whether that's this month or next month. So you think euro-dollar parity is on the cards? What sort of time frame would you give that for?
Well, this sort of thing is difficult to predict, but I think at least a couple of months, 6 months probably, something like that. The ECB, everyone's talking about quantitative easing in the Eurozone being announced. The ECB are absolute masters of announcing stuff and then not actually doing anything. I think parity will be achieved when it actually gets announced that we're going to get some proper action rather than just talk. And
you think that's what the ECB wants, is to weaken the euro?
I think definitely. The exchange rate is a big factor in the inflation rate, and with inflation falling, it's a quick win for the ECB by pushing the exchange rate lower.
Well, it's always great to hear from Alistair. Stay tuned to Duke's Copy TV for more interviews. But from London, goodbye for now.